Well, thanks for having me, Kelly. Restaurants just need a reset, right? I mean, when you just look at restaurants, just the sector by itself, uh, you can really understand why the Fed needs to do what they're doing, right? I mean, what we have is 18% type of food cost inflation, double-digit labor inflation. You can't have the type of sales growth you need in any environment to grow earnings or EBITDA. And so, ultimately, what restaurant investors should be happy with is a recession that results in lower food costs, in easing labor costs. And when you look at the 2008 to 2010 period, that's exactly what happened.
So, in other words, to put it differently, what you're saying is it's not obviously that restaurants want a recession. It's that inflation is so bad that some kind of slowdown that cures that is the best they can hope for right now?
I mean, it's really the only solution at this point. You just can't have this type of inflation, ongoing inflation. And we're not really seeing any signs that labor inflation is going to go away, even if food costs normalize. How long can you take, high single-digit type of pricing, right? I mean, groceries are even higher than that. So we really do need a reset here.
But is that reset, this is, again, I love this because it's like the macro argument we're having. And there are some who say, but that reset's happening organically and, things can't go up to the moon and they're going to correct. So explain why you think that's maybe not going to take place on its own without a little bit of a shove.
Well, the expectation of a recession is actually showing up in some commodity prices already, right? So in our opinion, June actually marked the peak of inflation. And so we've seen things like wheat, corn, oats, feed costs that tend to be the leading indicators of overall food costs peaking in June and having come down along with the overall commodity complex, right? Things like copper, gas, et cetera, gasoline, et cetera. So there are some early signs that inflation may have peaked based on the expectation of a recession. And so hopefully that only continues.
And I know you're not trying to make the call yourself, whether we're going to actually be in one or at what month or what time. But what would you say about what's priced into the restaurant stocks? Can you own them here or do you now have to wait?
I think the risk reward is heavily skewed towards reward. The sentiment is as negative as I've seen it ever in over 10 decades of covering the space. I don't even see any incremental sellers at this point, right? The valuations, even during the financial crisis, the company-owned valuations troughed in the low teens. We're right under 14 times right now in terms of PE. On the franchise names, they troughed in the very low 20s. Right now, we're at 20.8 times PE. So I think we're, if not at trough levels in terms of valuation, we're there. Again, that's barring liquidity crisis that just results in a sell-off,
sure.
A blind sell-off. But X that sort of short few days or a few weeks of a liquidity crisis, that's really where the troughs are in restaurants.
I'm surprised.
They tend to happen, they tend to happen before the last round of earnings revisions take place.
Great point, an important point as an entry point. So Wendy's, I can see being on the list, even a Wingstop. Why Dine Equity? Why would that one to you be especially attractive here?
Yeah, Dine, they own, IHOP and Applebee's, right? And they're completely franchise concepts. And so you don't have to worry about the margin headwinds. They generate over 10% free cash flow yield right now, so they can buy a ton of stock. The balance sheet is as good as I remember. It's certainly much better than the pre-COVID period. Applebee's is now a stable, some may even argue a low, percentage grower top line. Versus a contracting story for years and years pre-COVID.
Right.
So that story has transformed dramatically pre-COVID versus post-COVID. So I think, that's a name at a 10% plus free cash flow yield that investors, can make bigger mistakes out there.
Yeah, and they have. But that's interesting. It's been balance sheet transformation post-COVID, which a lot of people, myself, wouldn't have thought. Nick, thanks for your time and for the provocative call today.
Thanks for having me, Kevin.
Nick Setyan of Wedbush.